Who are Nanhua? Basically, Nanhua Futures provides a global derivative service and is mainly engaged in commodity and financial futures and options brokerage business, futures investment advisory service, asset management and securities investment funds. Nanhua Futures' total capital is over 15 billion yuan. Nanhua Futures currently has 35 branch offices in mainland China. The trading volumes, customer margin funds and assets under management all rank in the top of the industry. We were first established nearly a quarter of a century ago in 1996. In 2001, we established the first futures research institution in Shanghai. And in 2005, we launched the Nanhua CRB Index. In 2006, HENH International Futures was established in Hong Kong. Since then, international offices have been established in the USA, Singapore, and most recently in the UK. In 2019, Nanhua Futures became the first futures brokerage firm to be listed on the China A-share market. Nanhua Financial UK is regulated by the Financial Conduct Authority. So Nanhua are members of, or trading clearing members of, SGX, LME, CME, DME, HKEX, ICE, DCE, CFEX, Shanghai INE, ZCE, and the SHFE. So in terms of access to the familiar global exchanges, Nanhua can provide access and clearing. In addition, we can provide access to the international products has made available in recent years, and that's what we're going to be looking at today. Currently, there's a few ways to access and trade Chinese products. Firms can set up what's affectionately called a WFI, a wholly owned foreign enterprise, which is basically to set up an office in mainland China, hire local staff, and in other words, have both feet in China. Another access point is the international products that have been made available via the overseas intermediate route, namely iron ore, currently from DCE, and soon to be palm oil on the 22nd of this month. But there's also rubber, copper, fuel oil, and crude on the INE, and terephthalic acid on the ZCE. Nanhua, Singapore and Hong Kong are already overseas intermediaries, and Nanhua UK approval is imminent. So the third option is QFI, or the RQFI process, which is the Qualified Foreign Investor Program. And basically in 2002, in response to the admittance to the World Trade Organization, China initially launched this QFI program that allowed foreign investors access to China A shares, bonds, ETFs, index futures, warrants and funds. However, firms have had and also still have had quite a lot of requirements to meet. However, those requirements have since been removed. In 2011, the RQFI program was launched that allowed offshore yuan-funded accounts to trade into China, firstly for Hong Kong firms, and then most other financial centres were added. The RQFI was essentially a pared-down version of the QFI, and both of the schemes had good subscription, but traditionally less than 100% of the quotas were used by international firms. Since 2011, the Chinese regulators have removed the assets under management experience and the quotas, and as recently as last month, they combined two programs into one. Allegedly, the process of application has been reduced from 9 months to around 2 to 3 months. And the CSRC, the regulatory body in China, has stated that it will respond to applications within 10 business days. The fourth option is to use Shanghai Shenzhen Stock Connect, which is largely for the bond and stock market products. However, a week or so ago, the Hong Kong Exchange's chief, Charles Lee, suggested at the FIA Asia Virtual Conference more products could be added to include financial and commodity futures. So here's a simple summary of how Nanhua can provide access for overseas firms via the intermediary route. We can provide DMA and clearing services for the products under this program, and at the same time, access to all the equivalent international ARBs and futures on the international commodity exchanges such as SGX, ICE, Bursa Malaysia and the CME. So here's a combo of how the QFII and overseas intermediary routes work and how Nanhua is set up ultimately to access mainland products from stocks to funds and, of course, futures. US clients cannot currently trade into China from stateside. However, Nanhua has offices in the Caymans where US firms can set up and get access. Now, Tanjian just touched on some of the regulation in China at the moment, but the main regulatory body is, of course, the CSRC. But there's also the China Futures Association and the China Futures Market Monitoring Centre. The exchanges also have their own regulatory surveillance, as is found elsewhere in the world. All this is designed to promote market integrity and efficiency. Market manipulation of any kind is strictly prohibited, and the penalties are, well, painful, let's just say. So this next slide shows in more detail the overall structure of the regulatory environment in China. Oversight by the CSRC is absolute. There are currently 83 listed futures and options products in China. Highlighted in orange are the ones that are currently available. The ones in yellow being bonded copper. That was launched on the 19th of November at INE in Shanghai. As we've seen, Parmaline on DCE is going to be made available next week. And also the index futures on CFEX are currently available on the CFEX exchange via the QFII program. So since the first commodity futures were made available via the intermediary route, by the INE and DCE in March and May 2018 respectively, more have been added. Speculation is rife on what comes next, possibly pulp futures on INE, wood pulp futures, or maybe even the soy complex. Either way, China is only heading in one direction, and that direction is open. So here's how the Chinese exchanges rank globally, and as you can see, all three commodity exchanges in China fall within the top five based on volume. DCE was the exchange with the largest growth in volume 2018 to 2019 due to the huge volumes traded in iron ore and steel rebar. In terms of monetary values transacted on Chinese futures markets, in 2019 the total trading exceeded 4 billion lots, which represented a 31% year-on-year increase, which translates into a turnover of 291 trillion RMB, which is equivalent to 42 trillion US dollars. And that's a year-on-year increase of 38%. The DCE have also seen excellent growth since 1993. The figures for 2019 are impressive, with a total of over 1.3 billion contracts traded, nearly 70 trillion yuan in turnover, with an ADV of nearly 6 million lots. It will be very interesting to see the figures for 2020, given perhaps that China has weathered the COVID crisis better than any other country on the planet. So we saw some of the specs on DCE palm oil before from DCE, but here's all the contract specs for what's basically available. So we've got crude oil, TSR20 rubber and sulfur fuel oil on INE, iron ore and soon to be Parmaline on DCE, PTA on ZCE, and as I said before, on the 19th of November, the INE launched a bonded copper contract, which is a big deal and has seen great popularity in the launching of that contract. So all of these Chinese products are highly liquid and can be arbed versus international equivalents. INE crude can be spread against WTI on CME and also ICE Brent crude. INE rubber can be arbed versus TOCOM or SGX. INE fuel oil versus gas oil and ICE. DCE iron ore versus SGX or HKEX. Copper versus LME and CME. PTA can be spread against crude oil because it's a downstream product. It's not part of the cracking process. It's a derivation of the crude oil product. And of course, DCE palmoline can be spread versus Bursa crude palm oil and CME soy oil. Now, I found this wonderful little video on YouTube that shows the historical 40-year spread between soybean oil and palm oil. The last time I checked, it was about $40 a metric ton, but it's been as wide as nearly $400 per metric ton. So it's definitely a spread worth watching. So you can use Bursa crude palm oil versus soy oil, or palmoline in yuan versus CME soy oil. Choice is up to you now. Helmut is going to tell us a little bit more about that later today when he delivers his CQG presentation. So in order to get the best execution possible on these global hard trades, Nanhua has an extensive network of co-location connections to Chinese and international exchanges. In addition, we can clear all of them for our customers' convenience. A one-stop shop, if you will. So as Tanjian mentioned before, as alternatives to renminbi, warehouse receipts or dollars can be used as margin collateral. There is a 5% haircut on dollars when deposited, and dollars can only be used for initial margin. Variation margin is always in renminbi. All Chinese exchanges operate on a pre-trade margin basis, meaning that clients' cash, either RMB or USD, must be in the account before an order can be accepted by the exchange. Accounts will be designated either normal or hedge. In common with other Chinese exchanges, hedge will have lower initial margin and fee charges. Arbitrage trades against international exchange does not qualify for hedge status. So hedge status can only be permitted by the exchange, ultimately. Another important bit of news, the Ministry of Finance in China has announced a tax exemption for overseas traders on income derived from trading RMB-denominated Chinese futures contract. The tax exemption covers both institutional and individual investors. Now, just a quick look at China's booming economy before I hand over to Vincent. China's economy continues its recovery from the COVID-19 pandemic better than others. The world's second biggest economy saw a growth of 4.9% between July and September compared to the same quarter last year. This near 5% growth is a far cry from the slump the Chinese economy suffered at the start of 2020 when the pandemic first emerged. While the COVID-19 pandemic has hampered this year's growth targets, China also remains in a trade war with the US, which has hurt the economy. However, China's economy continues to grow at rates unimaginable in other COVID-hit countries. The draconian lockdown measures to control the virus, combined with some government stimulus, appeared to have worked well. Whereas here in the UK and elsewhere, we are about to enter lockdown 3.0. China's economy did get a boost this year from the Golden Week, an annual holiday in October that saw millions of Chinese people travel. So while we're all stuck at home, self-isolating and staying out of the public domain, Chinese were flying all over their country internally. And there were 637 million trips in China over the 8-day period, which generated a revenue of nearly $70 billion according to the Ministry of Culture and Tourism. Now, at the high point of Donald Trump's relationship with Xi Jinping, when they met in Beijing 3 years ago, the Chinese president reported to his US counterparts' pressure to liberalize financial services with a pledge: we will never close our doors. They will only open wider and wider. Barely had Air Force One whisked Mr. Trump from Beijing, and sure enough, China's finance ministry announced sweeping reforms to remove ownership limits on foreign financial service companies operating in the country, much to the delight of Wall Street. US-China relations today look very different. A battle is being fought on many fronts between the world's top two economies. Yet in the realm of finance, there is no evidence of relations breaking down. However, Trump is out, and Biden is now in and will take up residence in the White House next month. Relationships can only get stronger. So on that note, I would like to thank you all for listening. If there are any questions or queries, please don't hesitate to enter them in the chat box or contact me. I shall now hand over to Vincent from Bursa Malaysia, and we shall continue on.